Good afternoon, ladies and gentlemen. Today is Tuesday, February 11th, 2014. My name is Michael Camo, and I am an editor and columnist for Minival.com. Today, I'll be interviewing David Miller, who serves as the portfolio manager for the hedge fund Alpine BioVentures. David's expertise is biotech, and he serves as Minival's go-to expert in that sector. David, how are you today?
I'm doing well. Thanks for having me on.
Okay, we're going to get right to the big question, but let me lay out some statistics. In 2013, biotech measured by IBB was up 65%, actually outperformed social media, which some people think is in a bubble. Biotech's also up 12% year to date. Now, do you think biotech is in a bubble?
I think that there are certainly stocks that have whose fundamentals aren't in relationship to their market cap, for sure. Is the entire sector in a bubble? I would argue that no, it isn't. I think that if you are looking for an investment where companies have pricing power, where their margins, their gross margins are large, where they're actively spending on R&D and their return on R&D is improving, if that kind of a sector appeals to you, I think that biotech should appeal to you. But, you know, I think we have to be realistic. The sector was up a long way last year, and there are a lot of companies coming public, and there's a lot of companies already out there who are pretty well overvalued.
Okay, so in terms of your stock picking, do you go more for, I guess, the more mature companies that have drugs on the market and cash flow and earnings, and I mean, do you stay away from those more speculative plays?
No, I mean, we're all about the fund strategy is really twofold. We're going to hold some kind of core up-and-coming companies. These are companies that, you know, will have revenues, but, you know, the best is yet to come. They have good drugs in their pipeline, or their drug that they're getting revenues from is not is not approved in as many indications as it will be in the future, and so we'll hold those as kind of a core holding. But where our expertise is at Alpine is really finding companies whose science makes sense, their management team knows how to knows what to do with that science, knows how to design clinical trials, and these drugs are not yet on the market. So you know, that's really kind of our bread and butter, because we think we can really bring, you know, the 30-plus years of experience we have in the sector to bear on finding those companies and hopefully finding both the ones we think are going to fail, because we're a long-short fund, as well as the companies we think are going to succeed. So, yeah, we're really looking at the development stage biotech.
Okay, we only have a limited time here, so I guess we will have to keep things at a fairly basic level, but how do you assess, I guess, a company's ability to actually get something on the market? Because in my experience, almost every biotech company has a very, very interesting story. The drugs always sound spectacular. So how do you decide what's going to make and what's going to be broken?
That's a really good question. You know, only 1 out of every 10 of these companies that come public is actually going to succeed. The rest of them fail. And failure rate is miserable. And you know, with 30 years of experience, you know, with Mitch and I in the business, we are pretty good at figuring that out. And it all comes back to the science. You go and you read all the preclinical data, and you go and read all of the human clinical trial data. You know, I travel quite a bit to scientific conferences so that I hear, not only do I see the data presented, to talk to the investigators who actually use the drug, run the clinical trials, and they provide amazing insights. It's biotech. The returns look great. You know, if you do it right, the returns can be quite lucrative, but it's a lot of hard work, and where that hard work comes down to is you really have to know the science, you have to understand the FDA, and you have to really pay attention to what management is doing, because it's easy to get even a good drug off the rails and run, you know, trials that aren't very good, and so the trial fails the drug instead of the other way around. So But it's when you're looking at development stage biotech, it's all about the science.
Okay, so I guess, so would you say that good science generally leads to money, and so how do you balance the financial aspects of a biotech company with those scientific ones, and does one outweigh the other?
Yeah, I mean, I think good science always wins, because and you have to pay attention to what the market looks like. The greatest science in the world, if there's no market, or if it's a really crowded market, makes the eventual payoff very difficult. So it kind of depends upon what stage. So great science is almost always going to get you good gains in early in the path to approval. So, biotechnology companies, when they're doing drugs for humans, they've got to go through 3 phases of clinical trials. Phase 1 is they're just making sure that the drug has, doesn't have unexpected toxicity. Phase 2 is, they're exploring doses and they get better an idea of the efficacy of the drug. And then Phase 3, or the pivotal clinical trials, those are the trials that have to be run to get the FDA to approve it. So, science really makes a difference in Phase 1, makes a difference in Phase 2 as well, but you're also starting to understand what the market might look like. And then by the time you get into Phase 3, you have to know the science, because you can predict whether the Phase 3 is going to be successful, by the science and what kind of trial they're running. But if the trial's positive and the drug gets approved and nobody wants to use it, that's where the marketing and kind of the traditional, no different than a social media company or a company selling widgets comes in. There has to be a market for the drug.
Okay, now, what advice would you give to someone that, say, coming out of college, doesn't have a medical or scientific background? What would you tell them to get started? Are there certain things they should read, any publications or books maybe, for at least a very basic grounding in biotech?
I think that someone out of college looking, for biotech on the investment side, I think that you really have to read other people who do it already. Pick some good biotech analysts and read everything they do. One thing that's very different from when I started doing this without a science degree 15 years ago and now is Twitter. You can go up on Twitter and get a steady stream, if you're careful about choosing who to follow, a steady stream of really intelligent analysis, both scientific, market-based, and stock-based on these biotech companies. And then write, whether write a blog, write yourself, and keep track of what you're doing. And then, become really familiar with the librarian at your college or the librarian in your public library who can give you access to scientific publications, and read those, and you'll pick it up. It'll take a while, but you'll pick it up.
Okay, now in terms of your portfolio strategy, do you take a more macro approach versus a bottoms-up approach? And what I mean by that is, for example, do you look for trends like perhaps diabetes or obesity drugs, or is it more on a company-by-company basis?
Well, at Alpine right now, our specialty, we really focus on oncology drugs, cardiology drugs, and orphan disease drugs. And I think that science always wins, and so it's really about the company. Now, will we spend, if you look at my desk, it's piles and piles and piles of scientific publications. And so there is a kind of as you term it, a macro issue. If we think that, like if we're heading into a conference where we think there will be a particular hot subject, like, immuno-oncology or, maybe breast cancer or hematologic cancers, well, those piles will get shuffled on my desk, and I'll work up companies based on kind of an overall sense of what might be hot. Because that's part of being successful in the business. Is one of the things I learned the hard way when I was writing biotech stock research is you can be right on the science and not make any money because there's nobody else out there who's buying these stocks that cares. And so you have to be sensitive to both of them. You have to get the science right, otherwise you're going to get run over by bad clinical data. But you also have to have a sense of what everybody else is interested in, and then try to position your portfolio to capture that.
Okay, that was actually that is very helpful. So let's get into some names. All right, so one company that's been very hot as of late is Intercept Pharmaceuticals, which got some good data on a study shot from 80 to about 450 and has come down a bit. Do you have any thoughts on that name?
Well, I think Intercept is really interesting. I mean, this conversation. Oh God, did you see Intercept? It was up 200, and 200%? No, $200. Oh wow, it's up 160 again today. It's kind of turned into, honestly, this cautionary tale for anybody who wants to short development stage biotechnology companies. That stock was up it was up almost 4 points in 2 days. And there were 600,000 shares, or closer to 1 million shares out there short. So some people got their year ruined, and they had basically not even had their first cup of coffee that morning after their data. It's a company that has a really small float. The holders really believe in it, and they're not particularly interested in selling. So if you were short that name, that was a tough, well, it's a tough year. It was, 15 days into January, and it was a tough year already for you. And I think that, and I do believe that that has had an effect. There are a lot of small biotech companies out there who have billion-dollar valuations that even in past strong markets, like in 2003, which was a similarly strong market to what we saw last year, there was a cap because people would come in and start shorting these things, and I think people are a little scared to do that right now because of this Intercept example. And with Intercept, is this drug going to be the drug for NASH? I mean, I don't think we know that yet, but it certainly was good for that company, was good for companies like Raptor, and good for a few other companies too that have NASH drugs. And it was one of the funny things, kind of at the JP Morgan conference, it was, that was a joke going around, is everybody all of a sudden had a NASH drug in development because they wanted to capitalize on what happened to Intercept.
Okay, so speaking of shorting, so when you short biotech stocks, do you use options to sort of define your risk? Because how do you protect against basically a huge gap that goes in the wrong direction?
I think that what's really interesting right now is most of the hot, overvalued names are recent IPOs, and they don't have options trading on them, simply because there's not enough holders or there's not enough interest. Typically because there's not enough holders, because you can't list options unless there's over a certain number of holders of the stock, and these things are so closely held and their float's so small that they're just not above that threshold yet. So if you want to short these names, you got to do it. You just got to expose yourself. You got to do it straight up. And I think that you need to be very attentive, and I think that you need to have a very heightened sense of when data might arrive, and then size your position accordingly. If you think that if you are dead certain that you're not going to see data for 4 or 5 months, then you can be a little bit more aggressive on your position size. If you know that you're rolling into data, unless your fundamental work makes you darn sure that those data aren't going to be particularly positive, well, and clearly not positive, then you have to be, you have to back off of your position or cover it altogether into the data. So it's, as I think that Intercept showed, it's really tough to short a lot of the earlier stage billion-dollar market cap companies out there.
Okay. Another name that's come up a few times on Minionville, because Minionville's actually done quite a bit of coverage of what I guess we call the cannabis sector, but GW Pharmaceuticals.
Yeah.
A lot of people ask us about, ticker GWPH for those who aren't familiar. Do you have any thoughts on that name?
Well, I mean, I think that, I'm from Seattle, right? So, we have approved pot sales there now. Well, we approved it. We're still trying to figure out how to trying to do the rules to sell it. So, you know, I think that there is a great deal of interest in the pot trade. GW is an interesting play to that. You know, they have approved drugs. They have an approved pathway to get their marijuana, plant-based marijuana derivatives into the United States. Whether that's volume limited by the DEA or not is one issue. There are other companies that have synthetic THCs that have a little easier path, even though they are very well, you know, or highly regulated by the DEA. You know, it's, I think back to, you know, I've been around long enough to remember the first time that biotech IPOs were hot, and that was in the back half of 2000. The tech bubble had burst for, you know, hard tech, silicon tech, and there was all these tech funds out there looking for money. And what they decided to do is they couldn't invest in, you know, normal tech anymore, so they invested in biotech. And then all of these pick and shovel companies went nuts in the end of the third and fourth quarter of 2000, and that turned into a nightmare, of course. But I think that, and even in the back half of the biotech bubble, it was picks and shovels more than, you know, insert webname.com here, looking for page views and eyeballs. And I would suspect that that's, if you want to invest in marijuana companies, I would suspect that that's going to be the best place to do it. Find companies that are looking for, that do hydroponics, growing lights, solar companies, because most of these regulations are going to require indoor growing facilities, and so they're going to be huge power draws. So solar companies and things like that. So picks and shovels more than the pot companies themselves.
Okay, and I guess next question is, and I guess this is a sort of a personal one for me. What do you think about testosterone replacement therapy? Because I've noticed there's been a few companies.
This is a personal one for you?
Yeah, not personal. No, it's I'm doing quite well actually, but in sport, it's sort of become a hot topic in sports.
Yes.
And I have a theory that it will be that low testosterone will be the sort of overdiagnosed ADHD for adults.
It is, and it is already. And the FDA just recently said that they are going to do much more work into the cardiac and other side effects of the current testosterone replacement drugs on the market. These things are monstrously overprescribed. I mean, there are clinics out there who do nothing but specialize in low T. You see them on late-night commercials. You can't open a magazine, you know, a men's-oriented magazine without these ads. And you know, you know, it always used to kind of be fertility clinics, but they're not. You know, it's just, they're men's health clinics. They're franchises. You know, just like you can go and get hair plugs or something like that. In a franchise, you can go get testosterone drugs. These things, what's approved on the market right now, they're miserable drugs. They make you sterile. They give you all sorts of problems. The creams and things like that, if you get them on your kids or on your wife, it's really bad news for them, and this happens all the time. You know, I think it's a huge boom business right now, especially as baby boomers are getting older. But I think that the FDA, I would not be surprised over the next 2 or 3 years that the FDA starts pulling these drugs on the market or forces them into something called a REMS program, R-E-M-S, where the companies have to pre-approve patients to receive these drugs based on very strict, scientifically validated criteria that the FDA mandates.
Okay, so I guess looking at the broader biotech landscape, what are the names you like?
Well, I think one of our favorite names has to be Medivation. You know, this is a company that you know, I've been following for a number of years. They have a prostate cancer drug called Xtandi. Prostate cancer is a disease that if you live long enough as a guy, you're going to get. Whether you die from it or not is another issue, but you know, if you live into your 80s, you're likely going to die with prostate cancer. And so it's a big deal. Fortunately, it's a very curable disease, or at least it's a disease that we can put into remission. But and then you'll end up dying of just old age, which is kind of what you want to do with cancer treatment. But for 30 or so % of men, this kind of prostate cancer gets pretty aggressive. And Xtandi is a drug that actually helps block androgen, which is kind of the gasoline that fuels prostate cancer. And it's a great drug. It's a very non-toxic drug. And they just released data in a new indication in prostate cancer. The data were stunning. I've done a lot of work in prostate cancer over the years. I understand the space really well, and hands down the best data I've ever seen. It's probably worldwide going to be a $2 to $3 billion drug. The market cap, is $6 billion now. So it's a lot of it is in, but I think that there's a lot of people on Wall Street who don't understand that Xtandi is really going to put it bluntly, kick the crap out of Johnson & Johnson's Zytiga, which is already approved in this, in this new further ahead indication. And so I still think there's probably some upside there. And I think it's got to be at the top of everybody's list for a takeout candidate.
Okay, another big topic in the news is Obamacare.
Mm-hmm.
Now, do you see any impact from Obamacare on the biotech market as a whole?
Yeah, I mean it's the pharmaceutical company profit-making act. It's the Affordable Care Act, right? Well, it's the pharmaceutical let me sell my drug to even more people act as well. It's one of the best things that has ever happened to the pharma business. And I get when I say that, a lot of people scoff at me and say, "Well, hey, Dave, you're a Democrat. Of course you think that." But look, pull it up. Take a look at where hospitals went. Take a look at where insurers have gone, and take a look at how much pharma companies have gone up since the ACA was passed. And you'll see that this is not a law that hurts them. Now, are there going to be a great deal of changes coming along? Yes. Are we going to see price controls and things like that like we see in European countries out of the ACA? No, it's prohibited. So we're not going to see that. More people under coverage with insurance means more opportunity to sell high-priced drugs. And setting aside whether this is sustainable for a moment, with our healthcare spending, Obamacare, the ACA is a good thing for these companies.
Okay, so let's talk a little bit about ETFs, because you mentioned them recently in an article. Now, I referenced IBB. Yeah. But there's also XBI. Is there one ETF or index that's better than the other?
Yeah, I mean, it depends on what you want your exposure is. Anytime, and this is a good rule regardless of what ETF you're going to go and find, because I know a lot of people use ETFs as a hedge. You have to go to to whichever one of the companies is putting these ETFs out, and you have to go and look at what the concentration is. The IBB, both the IBB and the XBI are mimicking the NASDAQ Biotech Index, which is the reference index for biotech. The IBB, however, it's got about 50% of its weighting in about 10 names. And so it's, kind of as Gilead goes, so goes the IBB. And so if you own a bunch of large market cap biopharmas, and you want to hedge, well, the IBB is a great way to hedge. If you own a lot of large market cap biopharmas and you want to add more exposure, buying the IBB just gets you the same exposure you already have, so you have to be careful. I prefer the XBI. It's supposed to be equal weighted, but it's not quite equal weighted. But I mean, you get 60 or 70 companies down before you get into 50% of the market cap. So I watch the XBI. If we're going to hedge, if we think we need to use an ETF to hedge, we're likely going to use the XBI. It's more volatile. because it represents the more volatile, smaller companies, but I prefer that one. I think it's a better representation of the biotech space.
Okay, we're getting ready to wrap this up, so we'll close with one last question. Now, aside from individual names, do you have any outlook on biotech as a whole for, say, the next quarter?
Yeah, I mean, it's this time of year is traditionally when biotech will pull back, and we've seen some of that already with the overall market pullback. You know, we have typically a great January, spring is a little soft, we get a little run up into the AACR meeting, which is kind of early stage oncology companies in April, then we sell off a little bit, and then we get a run into June with the big ASCO oncology meeting, and then typically we have the summer doldrums. You know, biotech oddly is seasonal, and I always tell people, you know, who are really interested in the space, go back and pull an annual chart of the XBI or the IBB, you know, for 10, 11, 12, 13, and 14, and you can see the seasonality in there. So for the next quarter, I think it's going to be choppy, and I think it's going to be really volatile. Not only because I think the overall macro market is going to be volatile, as we transition from a weak economy with a lot of support from the Fed to a stronger economy with less support from the Fed, and all that entails, you know, that Mini-Bill does such a great job of making people understand all sides of that story. You know, I think it's going to be volatile. I think it's going to be a stock picker's market. So I don't think you can just buy them all and hope they go up. Pick good stocks, be sensitive to kind of the overall macro stuff, and I still think it's going to be a good year for biotech.
Okay, we'll extend with one more last question. We did see, which kind of ties in what you said, over the past few weeks, we have seen biotech get more volatile. You know, we saw consistent outperformance, and then all of a sudden we saw basically a W. It dipped down, then up, and down, then up. Now, do you think that's the start of it?
Yeah, I mean, you know, one of the interesting things about working in biotech has actually made me a better trader of, you know, kind of the overall macro market and the indexes, because biotech is the ultimate risk-on trade. And so you can watch biotech as a tell, and I write about this on the Buzz quite often. You can watch biotech as a tell as to kind of what's going on in the rest of the market. If if the market averages are going up and biotech is not confirming it, 9 times out of 10, there's something, you know, it's short covering, or there's something hinky going on with those market averages going up, and it's not likely going to be sustainable. And so, yeah, I mean, with what's going on in the macro market is, like I said, this transition between strong economy, weak economy, lots of Fed support, not so much Fed support. You're going to get a lot of volatility. People are going to just decide, hey, I just need to take risk off. Or, okay, well, now I need to put risk on. And biotech is going to, you know, it's going to swing pretty wildly because of that. It's high beta, and so it's always going to swing wild.
Okay, and that will close our interview. David, thank you very much for joining us, and we look forward to speaking with you again.
Yeah, absolutely. My pleasure. Thanks.